Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is July the 13th, 2023. It is now 4:07 p.m. Central Time. The bond market and mortgage-backed securities are closed for the day, and we have had a great couple of days after the inflation reports that we received both yesterday and today, which we had been talking about earlier in the week. So what we had here was a consumer price index report came out yesterday showing inflation not rising as much as expected. So that's what I want to point out here today for you, is that it's not rising as much. Inflation is still, things are still getting more expensive, but that's actually healthy for the economy in the long run. It's just that it can't get expensive too quickly. So you can't have products go up by 10% per year. They say that the appropriate level is about 2% per year. In some cases, we were seeing 10, 14% inflation, and that was really causing a problem. We were all feeling that. So I'm pointing this out because, again, inflation isn't, prices of things aren't going down. Okay, so when we show that the inflation went up, the prices went up by 0.1%, they still went up. It's just that they went up by an appropriate level. Now, take a look here at what we have in this report here. You kind of point something out here. So today we got the producer price index. So there's a consumer price index what came out yesterday, and today was the producer price index. And I always talk about that the producer price index is the supplies that make the products. It's the chocolate that goes into the Snickers bar. The Snickers bar is the CPI. The chocolate that goes into the Snickers bar is the PPI. So today was a PPI report. It showed inflation at 0.1. So 0.1% month over month. That is the lowest inflation rating to the producer price index report in 3 years. Think about it. What happened 3 years ago, guys? 3 years ago was COVID, the beginning of COVID. Inflation didn't kick in until later because that's when the money started flowing and getting spent into the economy. All the stimulus checks was spent into the economy. People were staying at home and they were just spending money, buying lots of products. So this was before the increase from COVID, and we are back to that number on the producer price index. So anybody who says inflation isn't coming down is wrong. However, take a look at this report here from right here, Reuters. This is interesting. It says U.S. producer prices barely rise in June. Core PPI subsides. Okay, subsides. But look at this sentence here. Inflation was the smallest in nearly 3 years. More evidence that the economy had entered a deflationary phase. That is not deflation. Okay, so you got to pay attention to these words. Deflation is when the prices of things become less. So it is when the Snickers bar that was $2 is now $1.75. That's not what it said here. It said that the report came out and said that the Snickers bar that was $2 is now going to be $2.20. Okay, so that would be more of the year over year numbers. It is not deflation that we're experiencing. So it's interesting that they said that we're now in a deflationary stage because we are not having any reports of deflation. We're having reports of inflation stabilizing, which is what we want. So how do home loan interest rates feel about all of this? Let's take a look here. Now, yesterday, we were up 75 basis points after the consumer price index report. So now today, here we are. Again, it's 4:11 p.m. Central Time. The bond market and mortgage-backed security market are closed, and we are closing up 42. Guys, that is a huge increase in 2 days. Take a look at the charts here. From the trough, the very trough that we had, about a week and a half ago, we are up over 200 basis points. Now, we've talked about that if you go back into the reports, that if we wanted to get back into the threes and things like that, we would need like a 1,200 point swing. But 200 points, that's a big swing in just a couple of days. And you can see that we broke through this Fibonacci, this 25-day moving average, this Fibonacci, this 50-day moving average. Now ahead of us is a 100-day, and then our nemesis, the 200-day that we could be going up against maybe as early as tomorrow. Okay, so things are happening. The 10-year Treasury drifted down 10 basis points, still at 376. Now, again, if you go back in history and look at the way that the 10-year Treasury and the mortgage-backed security 30-year fixed mortgage correlate, normally a 30-year fixed mortgage rides at about 2%, really about 1.8% to 2% over the 10-year treasury, which, as you can see, even on the high end, that would put us at 5.76. So we're still far out of line because we're sitting now more at about a 6.8. Okay, so we still need things to normalize when it comes to the margin between the 30-year fixed and the 10-year treasury. Something to look forward to because it will allow interest rates to come down rather quickly on mortgage-backed securities when the market feels that we are now headed for the true decline, and we will then begin to see yield spread premiums and things like that, mortgage servicing premiums and things like that come into play, and you'll see home loan interest rates come down rather quickly. So where are we as far as the home loan interest rates? Let's run our scenario here for the Brent Bruce Daily, the very well qualified 30-year fixed conventional, 800 FICO score, 25% down, single family residence, primary residence, the best of the best, 6.875. That's a heck of a lot better than the 7.25 we were talking about the last couple of days. I'm very happy to see us back in the sixes, but I really think that we should be seeing it down further towards 6.5 right now. Let's open up the Loan Store here, who is leading the charge. Right now, again, 6.875 is given a credit of $745. For only $205, you're getting to 6.75. If you want to pay 1 point, 6.25. And if you want to get down to that 6 handle, maybe 5.99, you're getting pretty close to 2%, 2 points, okay? Let's take a look at our friends over here at United Wholesale. Right now, 6.875 is costing $400. If you want to spend a point, you're at 6.375. But to get to that 5.999, back into that 5 handle, we're only looking at 1.820, so not even 2 points. And remember, it was only a couple of days ago. There's the parameters of the scenario we're looking at. A couple of days ago, I was pointing out that to get to 5.999 or into that 5 handle, it was over 3 points. Okay, so we've seen a big jump, or actually a big reduction in the cost to get to that 5.999. Again, if the client pays a point and the seller pays a point, you're at 5.999 today, right now. These are the things you need to pay attention to. Make sure that you like, subscribe, share, stay in touch, hit the notification bell in the top corner. I'll get back to you again soon. Bye.